the thought process here is that we're likely headed to a double top of around 4.3%. I think this could actually hit as early as next week or the week after. And I think that will continue to put pressure on stocks overall. And again, it's just an alternative. At some point you have to say, yeah, I can make more in stocks than 5%, but I'm also could lose a fair amount. So as people get more nervous, they're likely to switch more money over to the bond market.
Gareth Soloway is back. He is the Chief Market Strategist at InTheMoneyStocks.com and President of Verified Investing Education. We'll be talking today about the equity markets in the U.S., fixed income, where yields are going, where the dollar is going, gold, Bitcoin, emerging markets, China, Japan, and what the latest CPI data means for investors and traders. So lots to digest, lots to go over. Gareth has been a popular guest on the show and actually was the very first guest on the David Lynn Report way back in March when I launched, so I thought I'd bring him back on the eve of my reaching 100,000 subscribers. I want to thank everybody watching this channel for making it happen, for helping me along this growth and growing the David Lynn Report community. So before we continue, hit that subscribe button down below and help us get to 100,000 subscribers. Gareth, welcome back to the show. Always good to see you.
Thank you, David. It's great to be back. We're going to have a good discussion today.
Let's start with U.S. stocks first. So a bit of a consolidation period again. Let's pull up a chart and dive right into the charts. What are you looking at in terms of a breakout? Are we seeing a breakout anytime soon? Let's start with the SPY.
Yeah, so let's bring up the charts here and we'll take a look. So right off the bat, what we can see here is that the S&P has kind of fallen off of the highs recently and kind of tested this key support level. So support, and again, you look for pivots. And so this little good education for people, but to understand a pivot, it's the highest point with a kind of an up and down on either side that gives you a pivot. And so you can see right through this high to this high, and that's exactly the low of the day today on the SPY, or the S&P 500. So right now, this is a run-of-your-mill pullback in an otherwise bullish trending market. Now, from past experiences and past discussions with me is that I don't buy that we're in a new bull market, even though this is the longest potential bear market rally in history. I do think that's from too much liquidity still stuck in the system. So my guess is we bounce off of this and then eventually collapse back down before, really making a bottom maybe next year at some point. So it's interesting, but right now the S&P is at support. We are down. You mentioned CPI data. I think the biggest thing to note on CPI is that we basically came in at estimates or maybe slightly better, but the PPI data today showed a different story. It's starting to uptick. And I've said for a long time, and you can go back, David, we've talked multiple times in the last few months. I said, inflation's going to get sticky around 3%. And it's going to hover there, which is going to make it unbelievably hard for the Federal Reserve to lower rates and print money when the economy stutters. And I think that's where we are at this point.
Yeah, you did say that. And the latest CPI reading, just to clarify, was 3.2%, slightly harder than the previous month's 3.0%. Now, right. A lot of this has to do with energy prices slightly ticking up, and that moved the print overall. We'll talk about energy in just a bit, but let's come back to the equity markets. I asked this question to somebody else with Bitcoin, but I think the same question applies to both Bitcoin and stocks. For Bitcoin, for example, about an 80% upside from November's lows. However, zooming out, it's still 50% down from its all-time highs. What do you call this? A bull market or a bear market? I know this is a technicality for a lot of people, but perhaps for a trader that changes the way you think.
Yeah. So, my issue is this, right? And listen, I'm a huge fan of Bitcoin and actually continue to become a greater fan of Bitcoin in the longer term, because again, what I've loved seeing in Bitcoin is that every time we have a Moody's downgrade of banks, Fitch downgrades the U.S. credit rating, or we even saw back in March, some banks failing, we saw Bitcoin popping up. So it's establishing itself as this safety hedge when the banking sector starts to have trouble. Now, my only negative is, and this is why I'm kind of intrigued by what we end up seeing in the crypto markets, is that what happens if we go into a recession where we have de-risking and multiples coming in? So essentially risk assets just selling off across the board. And my fear, unfortunately, is that we could end up seeing Bitcoin coming down with the equity markets. And I want to show you this chart because I think it's very telling, right? So if we look at the NASDAQ, so I have the QQQ on one side of my screen and we have Bitcoin on the other, and I'm just going to remove these lines so it keeps it as simple as possible for us. But look at how far we are from the all-time highs on Bitcoin and look at how far we are from the all-time highs on the NASDAQ. So essentially, the NASDAQ retraced about 80% of its drop. Bitcoin's only retraced about 30%. And so the thought process is this: what if, just hypothetically, we go into a recession and we see the NASDAQ go back to the October 2022 lows? What happens to Bitcoin? I mean, you can't tell me that if the NASDAQ drops all the way back down here, we're not going to see at least Bitcoin retesting that 15,000 level or so. And I even think it could potentially go lower. So I think if we got a credit event, that's a different story. But if it's your run-of-the-mill recession, then you're probably seeing Bitcoin hit the lows again before going substantially higher.
You know what's really cool? Can you just leave those two charts back up? I'm so glad you put those two charts up side by side. You're right in that Bitcoin has very closely followed the NASDAQ. However, in the past, the beta for Bitcoin has been higher, meaning for every 1 percentage point move in the NASDAQ, the Bitcoin price has moved more. Not so much this year. Look at how the NASDAQ has moved up, just soared up there, and the Bitcoin has gone up. Oh, I mean, it's still up a lot, but it doesn't seem like it's still near its all-time highs of the NASDAQ. Right. Why the divergence in performance?
And so you're dead on that, right? In that if you had told me prior that the NASDAQ was going to go back up 40% from where it was in October of 2022, if I didn't know, I would say, wow, Bitcoin could be at 60, 70, 1,000 at that point because of such a run in risk assets. That hasn't happened. And I think part of that is this overhang of securities law or the SEC trying to figure itself out or what they want to impose on the crypto markets. That's made people just stand back. We know that the Ripple decision went in Ripple's, in their favor from the judge, but now there's an appeals process that's like 2 years out, and that's just going to kill the altcoin market for another couple of years, most likely. So I think there's part of that, and then I also think that there's just this waiting on the Bitcoin ETF. Is it going to be approved? Is it not going to be approved?
Okay. Well, what you're saying is that Bitcoin has been starting to move on independent micro forces, which is
right.
Bitcoin-specific forces, whereas in the past, Bitcoin was driven mostly by the stock market. So we're probably going to see more of that going forward, that Bitcoin is going to move on its own. Could that happen?
I do think that's the way it's going to slowly, and this is a process, right? Everyone wants it to be so quick in crypto, but I think you're slowly seeing where some days it's a risk on, risk off asset, and then other days the NASDAQ falls or the S&P falls because of banking conditions and worries there, and Bitcoin actually pushes up. So it doesn't really have a true identity yet, but I do believe that it's getting slowly more towards that digital gold, that safety play as a Bitcoin asset.
We've talked about, you and I talked about the 30,500 level for Bitcoin. Is that still a target for you?
Yeah, I mean, so basically we're just, if you look, and let me show my chart again on Bitcoin, because I think it's such an important chart to look at here, is it's just such a clear level that we've been hammering against. And you can go back all the way over here to 2021, and we just put that line through, and it basically has been the stopping point of the crypto market. So the thought process is this, is that you have a very clear line in the underbelly, which is right here, and it's right now right around 27.5 to 28,000. We have the 30, 31, 32,000 level, which is what we've been hammering on. Which one breaks? And what we know is that volatility has been sucked out of the crypto markets, which usually happens right before a major move. And what we know here is we have two levels to watch. If we break above this one, I think you get a big move up. If we break below this one, that's where trouble starts. You've broken the uptrend trend line at that point, and that's where you have to start getting worried about a bigger correction to the downside.
You know what's interesting is that you were right in pointing out that the moment that Fitch downgraded, and we'll talk about the downgrade in a bit more detail later, but the moment that Fitch downgraded credit, the news came out last week, immediately Bitcoin shot up. Of course, it didn't sustain that level, came back down the next day. I'm just wondering, hypothetically, if suppose we get a credit event down the line that could push down the equity sectors, could Bitcoin actually go up on that news and sustain that momentum? I'm just speculating. I don't know.
And I think the thing is now as we're getting closer and closer to that credit event, I don't know if it's this year, next year, or in the next 5 years, but what we see is with Japan having to loosen their yield curve control, that's pushing them closer to a credit event with 250% debt to GDP. I mean, again, how do you let interest rates go up when you have that much debt? It's tough enough for the US at, I think, around 130% debt to GDP. So there is that potential to have Bitcoin be a huge, huge safety hedge in that scenario.
Okay, so let's close off on Bitcoin's price forecast. Now, you're still sticking to the downside for the end of the year?
I am. At this point, I'm still angled there, but I will say this. If you take out that level that we just talked about around 31, 32,000, then I do think it frees Bitcoin to head to at least 35 to 36,000.
Well, nobody can predict exactly where the price is going to go next month or the month after, but traders watching this right now, they're probably looking out for signposts in terms of macro news.
Right.
What macro events or perhaps Bitcoin specific events need to be knocked out for price movements either way?
Yeah, I mean, number one, an ETF, a spot ETF would be a big event. I did hear that the ARK Invest spot ETF got delayed, so it didn't get rejected, but it got delayed. So there's no new news there. Bitcoin did downtick a little bit on that news, but nothing major. And then really, you're just watching for these credit events. And I think the biggest thing to watch for as a Bitcoin investor, watch the yields, right? So watch the 10-year. Do we start to break out above, let's say, 3.3% on the 10-year, which was, by the way, the high in October when the markets bottomed, yields topped. And so if you saw us take out 3.3, does that then put more pressure on treasuries and the selling of bonds by the US, which we have to sell, so many to kind of, fund what we're doing as a country? Remember, $1 trillion in interest alone now about on the US debt. It's atrocious.
Let me just ask you, and I'm going somewhere with this question. Do you think we'll be in a recession by this time next year, for example?
Yes, absolutely. I think by late this year, early next year, I think it's going to happen a lot faster than we're expecting. There's two key economic points that people always point out that why the economy is strong. Number one is jobs. Number two is consumer confidence. If you look at the jobs number and you break it down, you look at the underbelly, you're seeing part-time work having a big pop. Full-time is actually starting to decline. So the underbelly of the jobs market is starting to show some weakness. Consumer confidence, if you break it down between the rich and the poor, or the upper 50 and the lower 50%, the upper 50 that has investments in the stock market, their consumer confidence is soaring, right? But if you look at the underbelly of it, again, people that don't have investments, their consumer confidence is crashing. So the underbelly, again, is not good on the economic news side.
Yeah, it does seem that the rich are getting richer because of asset prices going up, and the poor aren't doing so well because of inflation and other forces. Now, to my point about recession, we'll talk about the impacts on other markets in just a bit, but we're closing off on Bitcoin. People are talking about the halving event next year, and historically, halving events have been followed by a rise in the Bitcoin price. But I brought up recession for this exact reason, because Bitcoin has never halved during a recession in its history. This would be a very interesting dynamic next year when we get a recession. Let's suppose you're right, we get a recession. A lot of people agree with you. We get a recession by next year at this time. Halving happens. Gee, what's going to happen? What's a stronger force?
Yeah.
Let's just speculate. Yeah.
So not only about the recession, but have we ever had a halving where the Fed has tightened aggressively and is not lowering interest rates and printing money and quantitative easing? And that's another thing. So what concerns me, and this is more an anecdotal thing, kind of where I look at what everyone's saying. And if you go on CryptoX or if you go anywhere else, what you hear is, hey, just buy Bitcoin now because you'll make a fortune when the halving happens. And I've been a trader for 25 years. And anytime I've ever thought that way, I've always lost. And so, it's when you expect something and it's so easy, oftentimes you're disappointed. And I would just caution people is that it doesn't usually work out that way when everyone expects it to be such.
It does sound way too easy, but yet it's worked every time in the past. So it's just tough. It's tough. It's tough to call what's going to happen this year. But like we said just now, a lot of different macro forces are driving against Bitcoin this time around. So yeah, interesting to see what happens. So do you have a target for us by the end of the year? Just ballpark it.
I mean, for Bitcoin, I think you're probably back towards 20,000. You some sort of flush out here to kind of make people question right now that you got so many bulls out there. So I would say more towards the downside target of that. And then again, I think you ask me 3 years out, it's way, way higher. And 5 years out, even higher than that, as I think, again, it does start to take on that safety trade as it gets accepted by institutions and invested by pension funds as well.
I'm guessing you have a similar outlook for the SPY, maybe a 20% correction drawdown from here.
Yeah, I do. I think at minimum, and again, just to quickly show the chart here, and I'm just going to bring it up for you guys real quick, is that at minimum, we probably need to go back to the lower end of this channel, right? So it's so amazing how charts work here, where, this is just an interim trend line. You can see we're right in the mix of that area where two supports are, and that's why we're getting a small bounce today. But if I were just to remove those, what we see here is a perfectly parallel channel, low to high to low, and look at what we tagged right up here, which now caused a sell-off. So the thought process is at minimum, we come back to the low end of that channel. And that's assuming no recession. If we get a recession, we're going a lot lower. We're probably retesting the October lows and going even lower. And just to show these channels, it's just such a cool thing. But I know Nvidia's having a big move down today. It's having a little bit of a bounce now intraday, but it's down, we're down another 3% on Nvidia. But look at the channel here. Look at the low end, and then look at where it topped out. Pivot high, pivot high, pivot high, and look at the big rollover. And that's probably where we're heading back to, right around this 390 to 400 level. So again, I'm a big fan of technical analysis. It's what I do, and charts always blow my mind, even when I've done it for 20, 25 years.
Yeah, that's an interesting point. You know what I like about you is that you have your conviction, you're staying with it, even though the short-term trends are going against that conviction. So when that happens, what do you do mentally? Do you reverse that and say, look, I'm going to start trading with the momentum, or how, or do you keep that conviction and just stay on the sidelines for now? Basically, my question is, you've got a longer-term outlook that the market's going to go down. Right now, the markets are still strong. What do you do?
Yeah. So the key is there's a couple ways to mitigate that. One is to dollar cost average. So anytime I'm getting in a trade like shorting Nvidia, I want to slowly inch into that short, because one thing I've learned in my career, if it's commodities, stocks, or even crypto, it can always go further in one direction against you than you even think. So you can mitigate that somewhat by dollar cost averaging in. The second thing is, as long as your thesis is still intact, you ultimately likely will be proven correct. And so, for instance, my thesis is that we will hit a recession. So I'm expecting a lot of these tech stocks to really roll over. We're starting to see that, but not to the extent that I ultimately expect. I really expect Nvidia eventually to at least fill this gap at 304 at a bare minimum.
Recessions have usually been coupled with a decline in the equity markets. There have been a few rare exceptions, but usually recessions mean a bear market. Again, few exceptions. Let me ask you, just, let's think outside the box. What would need to happen for this next recession to be coupled with a rally? Suppose we have a recession, suppose stocks rally. Let's reverse engineer that scenario and play it out. What needs to happen for that to happen?
I mean, that's a tough one, to be honest. It caught me a little off guard. I think it has to be coupled with aggressive loosening in monetary policy and maybe even printing of money. But that would also be, you'd also need inflation to really come down substantially. And I mean, there's always a possibility. I think one of the things we were talking about just prior was potential deflation out of China. Do we import that deflation? And I don't know if we will, but if you can get in a scenario like that, that could be a situation where equity prices would go up. But that would be the rarity for sure. I think it's important for people to understand that.
Right. Yeah, we are talking about not the base case, but some offshoot probability that could happen. But it's important to play out all scenarios here. Let's talk about China real quick, since you brought it up. So yeah, they recently reported deflation. It's possible they've been in a deflation for quite some time, but they've just reported it now. It's interesting because I'm reading that demand has been slow post-COVID for China. They've had the lockdowns for longer. Maybe some other reasons as well. I've read that recent graduates are finding it difficult to find jobs. I think about the youth unemployment rate is somewhere about 20% for big country. That's a lot of people, young people, not finding jobs. So they're seeing a lot of structural problems. Can you give us a summary of what you've looked at for the Chinese markets and whether or not that has a big impact on here in the U.S.?
Yeah. So at least for me, you have to couple anything with China investing with understanding that there's always the black swan event of something with Taiwan. So I think you have to kind of recognize, if you're going to invest in China stocks, just understand that there is that additional risk and you have to adjust your position size accordingly. Having said that, I think that they are in a tough spot, but they're a country that will print, and especially with deflation, it gives them the opportunity to print even more money to combat that. And to me, that's probably good for equity prices in China. So again, for me, looking at like the chart of, I'll bring up the chart of the Hang Seng so we can take a look at it here. You got a pretty clear position where you have this wedge pattern, right? We have a very flat top here. And what's amazing, by the way, since 2008, you pierced that high, but you've never broken above the 2008 highs. And now put that in comparison to where the S&P or the NASDAQ is, and that's pretty remarkable. So eventually, I think what's going on here is this is a bullish consolidation pattern. I actually think that the Hang Seng is likely setting up for a big move up. I've been a big fan. I think even for the last year, we've been talking about Brazil. Brazil started to break out as well. In fact, I got to show you guys this chart because it's one of my favorites. If we look at the monthly chart of Brazil, Here it is, right? Beautiful wedge pattern. Never even came close to the 2008 highs. But look at what's happening. You're starting to kind of inch above that area on this ETF, the EWZ. And that actually could be a huge play. So I'm in the camp where I think you can invest a little bit in the US, but you want to start looking outside of the US for better returns.
Yeah, interesting. Okay. Any specific emerging markets jurisdictions that would look better, or is it just a general foreign play for you?
Yeah, I think you want to, you can go to emerging markets just to kind of spread risk out. But I do like Brazil. I happen to really like the chart on Brazil. It really starting to look like it's in breakout mode, and it has so much upside. Just to get back to 2008 highs, you're talking about seeing a return of, basically 200%. And that's just going back to 2008 highs. So, and I'm not saying that's going to happen. I want everyone to understand, but at least it gives you that upside potential when you're factoring risk reward.
I'm just curious how you follow all these different markets, Gareth. Do you have like do you have like alerts for certain countries? I mean, you can't. How do you follow? You can't. You have every single country laid on a different screen, and you're just following. Like, how does that work?
No, I mean, I just scan, right? So like once a month, I'll just scan different charts. And if it piques my interest, I add it to a watch list. Same thing for stocks, right? And you can't go through every single stock. So I have a scanning process where I say, all right, anything that trades under this volume is under this market cap is out. And then I just go once a month through those charts and I'll say, okay, these stay on my watch list. And it maybe is like 20 or 30 stocks. Everything else I'll check out next month again.
Okay. Yeah. Speaking of things on your watch list, you've been tweeting about Apple, Nvidia, big moves, post earnings. Can you tell us about that?
Yeah. So, I mean, Apple, number one, I think you look at the stocks. If you look at what Magnificent Seven stocks made new all-time highs going into earnings, they almost all fell. The only ones that rallied were ones that weren't at all-time highs. So Meta, you had Google, and you had Amazon, and none of those were at all-time highs. So it seems like a lot of the Magnificent Seven got way ahead of themselves, and now reality is starting to come in. And what I thought was fascinating is you heard from Taiwan Semiconductor that their chip sales for phones were not good. You heard from a bunch of other companies, Qualcomm. And then so why was Apple still at its all-time highs? I honestly don't know. And then we saw the correction on Apple when they came out and they missed their iPhone numbers. So to me, it's people just not thinking. They're just piling into what's popular, and that's a recipe for disaster.
Yeah, it strikes me. It's interesting because Apple sales have gone down. But if you look at a company like Tesla, for example, another stock that you follow, I think this is like their most profitable quarter in their history. I think that's what they reported, and their sales have actually gone up. We talked about this last time in China. So I don't know if the Apple sales going down is a reflection of weaker consumer demand, because clearly you need money to buy a car more than you need for iPhones. Maybe we're just talking about different demographics here, so I don't know.
And I think that's part of it, right? Is that we now have a consumer base in the U.S. that's $1 trillion in debt, and it's continuing to spike. So essentially, people spent all of their COVID savings and are now just charging things on credit cards, and that's a recipe for longer term disaster as well. And then also, we talked about China, and I think that's the issue now with Tesla, is that Tesla sells over 50% of its vehicles in China. And with China's slowdown, I've heard that the Chinese sales of Teslas have fallen off a cliff. And so, there's a bunch of things. And then you add into that the valuation, where Tesla, like if you compare it to a Ford or GM, it's not even close in valuation. Now, again, they have Elon Musk, and that gives a premium. But what is that premium really worth?
Okay. Yeah, fair enough. So charts looking frothy on Tesla still. Let's go back to inflation, and in particular the energy market. Let's talk about oil. So in the latest CPI print, we saw energy spike up a little bit, which may have contributed to the slightly higher CPI print of 3.2% versus 3% from the previous month. Can we pull up an oil chart, Gareth, and maybe you can give us some color as to whether or not recent strength will continue?
Yeah, absolutely. So to me, it looks like oil is still on an uptrend before. And again, I'm not ready to short it yet. I have no problem swing trading as a short, and understand everyone watching out there that a swing trade for me could be just a couple weeks or even just a couple days. But if you look at this chart of oil, it's had a tremendous run since basically July. And it's still, again, there's this trend line here that goes all the way back to 2021. So if you look at that trend line, that's most likely the target on oil in the near term, and it's right around this 87.5 level. So for me, if we get to 87.5, I would expect oil to stall out and then likely pull back. Whether or not it breaks out after that, we'll have to see. But I do think that, again, you're in a position where there's kind of a soft landing narrative. I mean, I think you're getting holes in that now over the last week, but there's been this soft landing. And there's also been so many TV analysts and commentators talking up energy and invest in these oil stocks. In fact, I was just commenting on this chart before, MPC. I got to show you this one. Look at the run in this chart here. Look at that vertical run from just this low. And by the way, one down day in probably about 20 here, maybe even more. It was $117. It's now basically 150. And this is an energy stock. These usually don't move like this. And notice this, we talked about parallels earlier, but look at this beautiful trend line mirrored with this parallel line here. And so listen, I don't know, maybe this continues up, but to me, oil is getting towards that point. One more little push, and I think you start expecting a pullback in oil and oil stocks.
Yeah, also we have to keep in mind the weather. I don't know what the weather's going to be this winter, but I've been talking to energy analysts that diesel's going up, natural gas is going up in anticipation of a colder winter, so that could put some pressure as well. Yeah.
And I also think you have to keep in mind that narrative drives the market quite a bit. Right. And right now the narrative has been the Fed has engineered this perfect landing. The economy in the US, the GDP growth is going to be extra strong, everything's going to be okay. And that also creates this future expectation that demand is going to go up. And price reacts to that. And so as soon as we get some holes in that narrative and people start saying, uh-oh, here comes a recession, you likely see oil pulling back. And we're probably pretty close to that.
Interesting. Do you think we'll get to $100 before this pullback?
I don't think so without some sort of geopolitical issue.
Okay. We have to talk about the PPI index that came out today. The PPI numbers climbed 0.8% over the last 12 months, a bit harder than expected. Why are stocks falling on that news? I'm looking at the S&P. NASDAQ's down about 60 basis points. S&P is kind of down today. I'm talking about Friday as of noon Eastern time. Why are stocks reacting slightly negatively to higher PPI?
Yeah, so I think especially for risk assets like technology, which is high risk, what you're seeing is the 10-year yield continue to move up. In fact, the 10-year yield's a fascinating chart. And what we know is that the higher yields go, the more likely you see people saying, okay, I don't want to take the risk in these lofty valuation tech stocks. I'm going to take some money out and put it back in, let's say, a guaranteed 5% treasury or something like that. So one of the things I've noticed here is that even though a couple months ago, everyone was saying the 10-year was going to start to pull back, we actually had a breakout. You can see here's your trend line sloping down. We broke out. We retested that pullback level, that support now, and now we're heading up. And the thought process here is that we're likely headed to a double top of around 4.3%. I think this could actually hit as early as next week or the week after. And I think that will continue to put pressure on stocks overall. And again, it's just an alternative. At some point you have to say, yeah, I can make more in stocks than 5%. But I'm also could lose a fair amount. So as people get more nervous, they're likely to switch more money over to the bond market.
Okay, very good. The bond market you don't think is in risk right now because of the higher yields?
I do think, listen, I think the long end has to go up. And again, I was looking at this just recently and the expectations for inflation over the next 5 years have dramatically spiked higher now. And we're now gauging, or the market's gauging 2.5 to 2.6% inflation over the next 5 years. So my guess is that's going to head towards 3%. And again, that's going to keep that long end of the curve continuing up versus the shorter end probably stalls out here. Eventually, the uninversion will occur because of it.
Yeah, and usually that's a very good point because usually when the yield curve uninverts, we get a recession.
Yeah, that's right.
The recessions don't happen just because the yield curve inverts. It usually, in the past, actually every time it happens when it inverts and then uninverts back to zero. So let's watch for that. The final thing we haven't talked about yet is the U.S. dollar. So how do your yields outlook play into the DXY?
Yeah, so this is a good one because the dollar's been perplexing to me in the way that we had a breakdown in the U.S. dollar. And if I zoom out on this chart, we can see this longer-term trend line going back to 2021. We hit it. We bounced, we hit it, we bounced, we broke down, and now we've retraced to it. Now, we're still right into that level, but to be honest, the dollar's held up amazingly well. And I think what we're starting to see here is the chart itself is saying the dollar should pull back, but we also have now not geopolitical, but more issues with Japan, with China, and we know Europe's a mess as well. So the question is, does money start to rotate into the US dollar for safety? And I think that's what the battle is being waged right now within the US dollar, where you're getting money flow in, even though at the same time there could be pressures to the downside. So it's holding the dollar up here, and we could move up. And in fact, gold has been really struggling because of this relative strength in the dollar recently, even in spite of slightly higher PPI numbers like we saw.
Okay. I have to bring this up. The BRICs nations are having a summit soon. It's rumored that on the agenda will be this possibility of a commodity-backed BRICs unified currency, new currency, alternative to the US dollar, perhaps. I'm just not seeing the commodity prices move in anticipation of this. What are your thoughts?
No, they really are moving in anticipation of this. And again, I don't know if they expect it to not be a movable event in terms of not creating enough demand, or if they just don't think these countries are going to follow through. Maybe it's more talk than anything else. But you're right. I mean, right now, the gold market and the rest of the commodity market is not, the precious metal market, at least, is not reacting at all. So I always look to price. Price is always king. And right now, price is not. And just to show you, I want to show you guys just one more thing here that goes to that version of price being king, is that if we go to the S&P yesterday, right? So yesterday we had the S&P gapping higher. This is a 10-minute chart you're looking at, right? So we had the CPI numbers, which even though they were higher than last month, they still were better than expectations, right? They came in a little bit better at 3.2 versus a 3.3 expectation. The market out of the gate roared and then sold off the rest of the day. And yesterday I said, wow, price is king. This was supposedly okay news, yet price sold off. That's bearish. And then what do we have today? We have more pressure on the markets to the downside. So I really strongly encourage people to always look at price. Price is the true arbiter of what is going to happen or what likely is going to happen. And if price is not moving, it's probably not something we need to be aware of at this point.
Yeah, unless they have a major surprise. But I appreciate your analysis. Very thorough work today. As always, Gareth, we ran through everything that I could think of in a short amount of time. That was efficient. That was an efficient session. Where can we learn more from you? You do a lot of your own media work now as well. So where can we watch your stuff, your analysis and videos?
Thank you, David. And yeah, so everyone tune in. I do a free game plan every Monday through Friday, 9 a.m. And this has now become a super popular show, and I'm so proud of it too. But basically, I give day trade, swing trade levels. We go through the macro data, basically setting the stage for the day. It's free on YouTube, or you can find it on my Twitter or anywhere else. And then other than that, follow me at verifiedinvesting.com. Lots of great things coming there. InTheMoneyStocks.com is also a place to follow me. So I'm all over.
You know what I like to see is you interviewing other traders. I would watch that. Get a bull on. I like to see a little debate on your show.
I'll just throw this out there, David, but it did cross my mind to think about you and I tag teaming an interview and bringing people on and kind of going back and forth. I think people would love to see that.
Yeah, that would be fun. Well, we'll look into doing that. Thank you very much for your time today, Gareth, and we'll put the links down below to the sites you mentioned. Follow Gareth's work for now. Signing off. Thank you very much.
Thank you so much, buddy. Take care.
Yeah, take care, and thank you for watching. Don't forget to subscribe.